Good morning. Continue on with Niaga AWANI with me, Ibrahim Sani, my colleague Nabilah Khaleeda, taking over from our other colleagues just now that you saw, Harits Asyraf Hasnan as well as Nina Rozman. We're going to have Professor, K.S. Jomo, the Senior Visiting Fellow at Khazanah Research Institute. He's joining us very shortly to discuss the federal impact on Malaysia. But now we move on to our first story. Now we know for a fact that yesterday the Federal Reserve on Wednesday enacted its second consecutive 75 bips or 75 basis point interest rate hike. Of course, this increase is meant to seek down to tamp the runaway inflation without creating a recession. In taking the benchmark overnight borrowing rate of up to a range of 2.25% to 2.5%, the moves in June and July represent the most stringent consecutive action since the Fed began using the overnight funds rate as the principal tool of monetary policy since the early 1990s. Now, while the Fed funds rate most directly impacts on what banks charge to each other for short-term loans, it does feed into a multitude of consumer products such as adjustable mortgages, auto loans, as well as credit cards. The increase takes the funds rate to its highest level since December 2018. Stocks hit their highs after Fed Chair Jerome Powell left the door open about its next move at the September meeting, saying it would depend on the data. Central bankers have emphasized the importance of bringing down the inflation, even if it means slowing the economy as well. Along the rate increases, the Fed is reducing the rate of the size of the asset holdings on its nearly $9 trillion balance sheet. Markets expect the Fed to start cutting rates by next summer, even though committee projections released in June this year show no cuts until at least 2024. The central bank has faced critics both for being too slow to tighten when inflation first started to accelerate in 2021 and for possibly going too far and causing a more severe economic downturn.
At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Despite these developments,
Federal Reserve Chair Jerome Powell says he doesn't believe that the U.S. is currently in a recession. Powell's comments came during a press conference after he announced the Federal Reserve on Wednesday raised its benchmark interest rate by hefty 0.75 of a point for a second straight time in its most aggressive drive in 3 decades to tame high inflation.
I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. Unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Little changed since January.
So joining us on the line live is Dr. Jomo Sundaram. He is the research advisor at the Khazanah Research Institute, as well as visiting fellow at the Initiative for Policy Dialogue at Columbia University. Good morning, Doctor. How are you?
Fine. Thank you very much for calling.
Yeah, thank you again for coming online. I just want to talk to you about the impact of the Fed rate hike. But before we talk about the impact on Malaysia, let's talk about the addressing of the inflation issue. Do you feel that this is a supply issue or a demand issue? And do you feel that the monetary policy on tightening it is actually addressing either problems?
Well, I think both issues, both the demand side as well as supply side factors are at play. But at the world's level, it is really the disruption of supply lines which have been taking place even before the pandemic. For example, when President Trump and Prime Minister Abe called for their companies to reshore from China and elsewhere, this basically disrupts existing supply lines. And of course, we are in Southeast Asia are very much involved in a lot of the supply chains involving China and so on. So this was a major blow. Then following that, of course, you had the pandemic and its own effects on supply side disruptions. And then more recently, of course, you have the deliberate effects of imposing sanctions following the Ukraine invasion. Now, all this, I think, needs to be considered. There are, of course, other factors at play. But very importantly, I think it is primarily a supply-side problem, although one cannot discount the fact that, the slow recovery from the pandemic, slower in some parts of the world, faster in other parts of the world, does mean that there is some increase in demand in particular areas. But on the whole, I think we have a supply-side problem. And therefore, raising interest rates, which are basically intended to address the question of price increases and because of excessive demand, is not a very effective tool. It will have a little bit of effect, but it will not have much effect in terms of addressing inflationary pressures. That's why I'm not surprised that Paul Krugman, for example, came out suggesting that inflationary pressures are basically already, ameliorated even before the latest announcement.
Dr. Joma, a follow-up question to this, because Jerome Powell, in his presentation to the U.S. Senate very recently, did admit that the Fed is slow to raise rates. We know for a fact that the rate hikes is still needed. However, it may not necessarily address the inflationary problems, considering that the supply side is going to be a whole different story to this. Do you feel that this rate hike, while it is too little too late, is still necessary to be done?
Well, this is a difficult and complicated question. The whole question begins with, of course, introducing the whole question of unconventional monetary policies, particularly quantitative easing, following the global financial crisis of 2008-2009. So instead of financing fiscal efforts, the U.S. especially, but also other countries in the Western Bloc have played an important role in cooperating to try to keep interest rates extraordinarily low. And this was reasonably successfully done, although I would suggest that much of those depressed interest rates did not really contribute to the growth of the real economy. It certainly contributed, for example, to the ability of big corporate players to borrow at very low cost and to do acquisitions, for example. This was a very important phenomenon during the last decade before the pandemic in the U.S. In Europe, the phenomena played out very differently, but this maintained the illusion of that the economy was not going into recession. But the recessionary tendencies ever since then have been meaning ever since the global financial crisis, have been strong, precisely because fiscal efforts were largely eschewed. And so Powell's efforts, because the U.S. is so important in the world economy, may well hasten the recessionary tendencies. And this is why some of us have been warning about the likelihood of a stagflation happening. On the one hand, economic stagnation, and on the other hand, continuing inflation. And this is something which we had before a long time ago in the 1970s, the second half of the 1970s. But I think it's very important to emphasize that the factors surrounding this stagflation this time are likely to be different. And so it does not lend itself to the kind of solution. In fact, the solution from 1980 of the previous Federal Reserve Chair, Paul Volcker, was brutal. It basically raised interest rates so high that basically it killed the world economy for over a decade. And particularly in the developing world, the world economy was in very bad shape. Now, some people who are also concerned that that because of close to full employment in the U.S. In the recent period, and the phenomena such as what is called the Great Resignation, where many people were not happy with their jobs, would resign from their jobs to move on to better jobs, and so on and so forth. This phenomena, this raising of interest rates would basically further weaken, working people's earnings, especially in the U.S., but also, I would argue, elsewhere in the world. So it is a very, very ominous thing. Now, whether or not there is already a recession in the U.S. is something which I'm not in a position to judge. But the consequences for the rest of the world, given the central role of the U.S. economy and U.S. interest rates in the international monetary non-system, because there has not been really a proper international monetary system since 1971, since Nixon pulled the U.S. out of the Bretton Woods arrangements. So we have a very, very dangerous problem and very poor coordination among central bank governors. As everybody knows, Governor Kuroda of the Bank of Japan has been very resistant, and he has consistently been arguing over the recent period that this is a supply-side problem, and raising interest rates is not going to address that. So Japanese interest rates so far have continued to resist, but it's very difficult to resist because of the strong influence of the U.S. in the world economy. And of course, we all look bad now because funds will flow to the U.S. and exchange rates of many other countries vis-a-vis the USD dollar are going to be very weak. But it's not really a reflection of the strength of the U.S. economy. And this is the tragedy of the situation. We have going to have a strong U.S. dollar without a strong U.S. economy.
All right, Doctor, do you feel the stagflation risk has increased considering that the unconventional monetary policy continues to persist?
I don't think unconventional monetary policies are the order of the day anymore. I mean, basically, as far as the West is concerned, Kuroda, Japan being the exception in this regard, as far as the West is concerned, they have basically moved away. The first 75 basis points increase basically signaled that it was the honeymoon, so to speak, was over as far as the U.S. was concerned. And so we do not, that era is over. Instead of quantitative easing, we now have quantitative tightening. And this in a situation coming out of the last part of the last decade, and coming out of the pandemic, and with additional trade disruptions due to the sanctions being imposed. All this is going to be quite difficult for many people in the world, and we already know, for example, about food price increases and so on. And these are very much related to such factors rather than necessitated by the world economic situation, or even narrowly speaking about the U.S. economic situation. So this is a policy which is very consequential, but not necessarily going to be effective.
Yeah, that's the thing, Doctor. In fact, one could argue that this 75 bips hike is something that the market not only has priced in, but actually know for certain that it will happen. Yet we are still on this track of tightening monetary policy, and a lot of economists, including your good self, sir, argue that it may not necessarily address the big problem. Do you feel that we need greater measures of control in order for us to address the inflation issue that is currently happening in the US, and perhaps, as you would put it just now, because of the US being a very important economy, it does reverberate across the entire world. What do we need right now, Dr. Jomo?
Well, I think, Ibrahim, the point you've made is an important point, but, you can't, there are very few policy options available to economies such as Malaysia. Those options need to be weighed and considered very carefully. And it's since I'm not a policymaker, it's not for me to say what exactly should be done and so on and so forth. But it's we are between a rock and a hard place, as the expression goes. There's no easy way out of this situation. And the fact that Malaysia, especially in the last couple of decades, has refused to use fiscal policy much more effectively is a big problem. And now it's very difficult because we have, the revenue is so tax revenue is so low, and the wiggle room for fiscal policy is very limited. So if you're stuck with monetary policy, when you, as the whole expression goes, if all you have is a hammer, everything looks like a nail, So you begin to think in terms of past experiences and how to deal with those experiences. But being an economy like ours, which is deliberately very, very open, for example, some of us have been arguing since the 1990s, in fact even earlier, that we should have much more stringent requirements on capital controls and so on. But you don't do that in the middle of a crisis like this. There's not much capital to keep inside. When you close a bird cage after the birds have flown, you're not going to achieve very much. So I think we should not have these kind of knee-jerk reactions of looking back in the Malaysian past and looking for simple analogies. What we really need is a much more creative way of dealing with a very serious problems. But if you don't raise interest rates because of market expectations, a lot of this is just simply driven by market. And if you continue to be how should I put it? If you have no choice but to allow the market to dictate choices, then you're not in a position to make policy very effectively. And this, unfortunately, is a problem which we have in Malaysia. But whether you raise interest rates and how those interest rates, if you don't raise interest rates, your exchange rate is likely to go south. If you raise interest rates, you're probably going to slow down further an economy which is already in bad shape. So, that is a devilish choice. And unfortunately, we are in a situation that because of our high exposure and dependence on the world economy dominated by the U.S., we are all, to varying degrees, of course, vulnerable to their decisions. And they make their decisions, especially the Fed. The Fed doesn't care a hoot about what is happening in the world economy. They are interested in what is happening in the U.S. economy. And even the U.S., in the U.S., of course, you have very different interests. You have the interests of the financial interests, you have industrial interests, which are diminishing almost by the day. And then you have the majority of the population who are basically salary earners, wage earners. And they all have very different interests, and so that one cannot even talk of a common American interest. Okay, whether is it really in the American interest to have a very strong to have a very strong exchange rate as is going to happen now. Well, this was certainly something which President Trump, who appointed Chairman Powell, was very intent on. But the American economy, as everybody knows, is not exactly the most dynamic locomotive in the world economy today.
Contingent to the monetary policy issue, right? We need to talk about geopolitics a bit. While Russia may not be directly impacting the US inflation issues, it does exacerbate it because of energy supply constriction. So how does this fare into this rate hike?
I'm not quite sure. I mean, the whole energy question is very, very complicated today. Okay, in I think it was the early 1970s, the U.S. after the end of the Bretton Woods system, the U.S. dollar was really very vulnerable at that time, and the U.S. basically made a deal, basically forced the late King Faisal of Saudi Arabia to push for this phenomenon which we call petrodollars. Okay, so ever since then, that market has been dominated, has been all oil and gas transactions have been in US dollars ever since then. Now, but of course, more recently, you have very major challenges to that, and the most important, of course, is that of Russia. It's not that Russia doesn't want to play ball. But now, since the U.S. is basically going after Russia, Russia is basically exercising some degree of independence, and reasonably successfully. I mean, after the initial days when the Russian ruble was said to be in the rubble, today the Russian ruble is actually very strong. It's the strongest it has been for quite some time. Now, not necessarily always a good thing, but this basically means it is because the Russia has been able to make alternative deals, has been able to sell its oil and gas to others. China and India being the most prominent, but there are also others, and all this basically means that the attempts of the sanctions is actually having an adverse effect on U.S. hegemonic interests. Whether or not the actions are going to serve U.S. interests is still very much in doubt. Now, what the energy prices, if I understand your question correctly, are sort of they're unlikely to stabilize because of the war policy. And that's why some of us feel that the whole question of negotiations and a peace settlement is so vital to try to normalizing conditions for economic stability as well as the normalization of economic relations. But that's easy for somebody like me to say, but it's much more difficult to achieve. That's why I think many people in the world, not just in this part of the world, hope that something comes about from say Indonesian President Jokowi's initiatives to try to mediate between Ukraine and Russia. And this kind of thing should be done really by others as well. And there are others who have been willing, ranging from the Pope and so on. But unfortunately, I think the conditions are not ripe in the U.S. What is happening now is that Europe, especially the major economies, Germany, France, Italy, which is difficult to say, but certainly Germany and France are now dissenting increasingly from the U.S. determination of NATO policy, and not only on the military and strategic front, but also increasingly on the economic front. So we are likely to see a great deal of uncertainty in the days and months ahead before things begin to settle down. So it's a very, very volatile situation, unfortunately. And one of the major problems which we have in the world economy is that in the last 2 or 3 decades, there has been a great financialization of the world economy, and this has opened up the room for all kinds of speculation. So a lot of things are being driven really by financial speculation rather than the real economy. So even if you make efforts which are able to stabilize the real economy, they can be easily upended by what is happening in the financial sector. A case in point, of course, is now food prices are not rising simply because of the real economy problems which we all know about, Russia, Ukraine, and so on and so forth. But also additionally, besides climate change, global warming, we also have the additional problem, which is very, very serious, of continued commodity price speculation. And although commodity price indices are less significant today, all this basically plays a very, very major role in worsening volatility.
What's interesting is that on the play card on your name there, Dr. Jomo, is the impact on Malaysia, and yet we haven't asked you on the impact on Malaysia just yet. Maybe 1 minute, Dr. Jomo, on the direct impact on Malaysia, considering this 75 bips hike after a 75 bips hike last month?
Well, as I hinted earlier, it's not that I forgot about Malaysia, but as I hinted earlier, we have a situation where the authorities are caught between the devil and the deep blue sea. Part of the problem, of course, is that they have allowed the fiscal situation to deteriorate greatly in the last quarter century, ever since the Asian financial crisis. So we do not have very effective fiscal tools, and we have a great deal of borrowing off balance books, off the balance sheet, which are being used to finance projects, many of whom will never see an economic return. Okay, if you think of some of the infrastructure projects, they are not expected to see any kind of serious economic return. So we are accumulating a great deal of debt, much of which, of course, is publicly announced. But there's also a lot of debt which is not publicly announced. It doesn't even go to Parliament. What's on the what is being borrowed for the so-called GLCs and so on, and this is a very, very major problem. It's a very major problem because these chickens will come home to roost sooner or later. So we have a major problem of sovereign debt increasing, but sovereign debt increasing in such a way as not to provide the basis for future growth. I wouldn't mind if sovereign debt was increasing if it was providing the realistic basis for future growth. But a lot of these projects are driven by opportunities for aggrandizement and so on and so forth, rather than on the basis of real economic needs. And this, unfortunately, is a very, very major problem. So we need to deal with those problems, but those are not things which can be handled in the short term. So the Bank Negara will probably be in a very difficult situation of having to make a difficult decision. People will criticize the central bank because the ringgit is going south. But what else can the central banks do? If you raise interest rates, there will be a new round of criticisms for raising interest rates. And so it's a very, very difficult situation for the central bank. And what we need is an overhaul of economic policy. But, we have, unfortunately, a political situation which does not lend itself to, medium and long-term economic solutions. All we have is a little bit of short-term troubleshooting. Yeah. And this is not the basis for much, for a good basis for a future.
Thank you very much. That was Dr. Jomo Kwame Sundaram, the visiting senior fellow at KRI. He is also, of course, the visiting fellow at the Initiative for Policy Dialogue at Columbia University, joining us live via phone call. Unfortunately, that is all the time that we have. Nabilah, how do you find the conversation?
Very insightful. I learned a lot of things.
Yeah, fantastic. So continue to stay with us. We're going to unpack this story and its impact on Malaysia over the day on Astro AWANI. But for now, that's it from myself, Ibrahim Sani.
And I'm Nabilah Khaleeda. Thank you so much for watching.